You just made your first $1,000 on the side. Maybe you drove for Uber on the weekends. Maybe you sold designs on Etsy, walked dogs through an app, or freelanced some graphic work for a local business. Doesn't matter how, but $1,000 hit your account that your day job didn't provide, and it felt like a cheat code, like you'd finally unlocked a secret your parents never mentioned. So you spent some of it, paid down a credit card, treated yourself to something you'd been putting off, left the rest in your checking account and kept hustling. Because that money was yours, right? No boss skimming it, no HR department carving it up before it hits your bank account. Just pure, unfiltered income, straight from the work you did on your own time, on your own terms. Then tax season rolls around. You sit down with your return, or you open up one of those tax apps, and there's a number staring at you that makes absolutely no sense. You owe. Not a little, enough to wipe out a serious chunk of what you made. And you're sitting there thinking, I already paid taxes through my job. I already had money taken out of every paycheck all year. How do I owe more? Because that side hustle money, nobody warned you about what happens to it. It gets taxed differently than your paycheck. The rules are different, the rates are different, the timing is different, and the IRS does not care that you didn't know. That $1,000 was never $1,000. It just looked like it while it sat in your account. And by the time you figure that out, you've already spent it like it was real. This is the tax trap that nobody explains to you before you start a side hustle. And by the end of this video, you're going to know exactly how it works, exactly how much the government actually takes, and exactly how to make sure you're never surprised by it. Let's get into it. Here's the thing about a regular W-2 job that most people never stop to think about. Your employer does a massive amount of tax work behind your back, and you never see any of it. Every paycheck, they pull out federal income tax, they pull out state income tax, they pull out your share of Social Security, they pull out your share of Medicare. I've covered this in my episode about the pay stub tax breakdown, but the point is this: you never touch that money. It evaporates before your direct deposit even lands. And on top of everything they take from you, your employer is also paying a matching portion of your Social Security and Medicare taxes out of their own budget. You never see that number on any pay stub because it was never part of your compensation. It's completely invisible. Now here's where side hustle money shatters every assumption you've been operating under. When you freelance or gig or sell stuff independently, you are not an employee, you are self-employed. And that single distinction changes the entire tax equation. When you're self-employed, there is no employer on the other side of the table, nobody to split the bill with. You are the worker and the employer. Both roles, one person, one tax bill, which means you pay both halves of the Social Security and Medicare contribution all by yourself. That's called self-employment tax, and it clocks in at roughly 15% of your net earnings. That's 12% for Social Security, 3% for Medicare. At a regular job, you'd only feel half of that hit because your employer quietly absorbs the other half on their end. When you work for yourself, that invisible half becomes very, very visible, and it comes straight out of your pocket. And here's what makes it really sting. Self-employment tax is not a replacement for income tax. It's an addition. They are two completely separate obligations that stack on top of each other. So let's say you're paying 12% federal income tax from your day job, and your side hustle income falls into that same tax range. You're now looking at 12% income tax, plus a little over 15% self-employment tax on every dollar of side hustle profit. That's over 27 cents of every dollar gone before you even look at what your state takes. And some states take plenty. If you're in a state with a 5% income tax, that's 32%. If you're in a state closer to 8 or 9%, you're pushing past 35% of your side money disappearing to various levels of government, on income you thought was yours, free and clear. This is the fundamental trap that catches first-time side hustlers. You see $1,000 come into your bank account and your brain registers it as $1,000 earned, $1,000 available. But the truth is, it was never $1,000. It was maybe $700, maybe $650, maybe less. The rest was always owed to the government. Unfortunately, you were just holding it temporarily, like a coat check for the IRS. And what makes this especially painful is that nobody in the gig economy tells you up front. The rideshare app doesn't tell you. The freelance platform doesn't tell you. The client who sends you a check doesn't tell you. They all show you the number, the big number, the exciting number. And you build your financial plans around that number. You budget around it. You make decisions based on it. And then the tax bill arrives, and suddenly your math doesn't work anymore. Not because you earned less than you thought, but because you owed more than you knew. Let's talk about the paperwork side of this, because it's where people get blindsided the hardest. The people who skip past these facts are the ones who get left behind. At your day job, you get a W-2 at the end of the year. Simple form, it tells you exactly what you earned and exactly what was already withheld in taxes throughout the year. The math is largely handled for you. You plug the numbers into your return, maybe you owe a little, maybe you get a refund, and you move on. Not too hard. When you do side work, however, the company or platform or individual client that paid you sends you a different form entirely, a 1099. And what the 1099 communicates is brutally simple. Here's what we paid you, full stop. That is the entire message. No taxes were taken out, nothing was set aside, nothing was withheld on your behalf. The government essentially tells you, figuring out what you owe on it is your problem. The IRS gets a copy of every 1099 that's filed. They know exactly what you were paid. They're just sitting there waiting to see if you report it on your return. If the number you report doesn't match the number they have on file, they strike. Here's the part that most people get wrong. You do not need to receive a 1099 to owe taxes on the income. This is a myth that gets people in real trouble. If a client paid you $400 for a freelance project and never filed a 1099 because they weren't required to, you still owe taxes on that $400. If you made $200 selling homemade candles at a weekend market, there's no 10-99 for that transaction, but you still owe. If you tutored someone's kid for cash, you still owe. The IRS rule is clear and brutal. All income is taxable unless specifically exempted by law. So that cash you made selling things online, the Venmo payments for side jobs, the money from tutoring, consulting, designing, all of it counts, regardless of whether a form was filed, regardless of whether the amount was large or small, regardless of whether it was a one-time thing or an ongoing arrangement. You may hear all this and think, well, if nobody sent me a form and the amount was small, how would the IRS even know? And look, maybe they won't catch every small transaction this year or next year, but the walls are closing in on that strategy faster than most people realize. Payment platforms now report transactions to the IRS. If you receive payments through PayPal, Venmo, Cash App, Stripe, or any third-party payment network, those platforms are filing a 1099-K on your behalf, whether you ask them to or not. The reporting threshold has been dropping. Your bank activity can be cross-referenced against reported income. And if you ever land in an audit, unreported income is one of the absolute fastest ways to turn a routine check into a serious, expensive, sleep-disrupting problem. Interest, penalties, back taxes, sometimes liens. It's not worth it. The IRS will drown you in fees and paperwork unless you follow these steps and stay on top of things. What you actually need to be doing is straightforward. Track every dollar that comes in from side work, every single one, and track every dollar you spend to earn it, because those expenses are going to be your best weapon when the tax bill comes. They're the difference between paying taxes on everything you brought in and paying taxes on just your actual profit. And to be clear, this isn't about trying to be clever with the tax laws. This is about using the parts of the system that were built for people in your exact situation. There are deductions and structures specifically designed for self-employed earners. Most people just never learn about them until it's too late. But before we get into the amazing life hack called deductions, there's another piece of the system we need to know first that blindsides side hustlers like yourself. This is the part that nobody, and I mean nobody, tells you about until you've already missed a deadline and there's a notice sitting in your mailbox from the IRS. When you have a regular job, taxes come out of every paycheck automatically, a little bit every 2 weeks. At the end of the year, you file a return and settle the difference. Maybe you owe a small amount, or maybe you get a refund, but the vast majority of your taxes was already handled in those bi-weekly deductions. But with self-employment income, nothing comes out automatically. There is no payroll system. There is no employer withholding. Every dollar hits your account untouched, and with a tax obligation silently attached to it. On top of this, the IRS has a system for people in your position: quarterly estimated tax payments. 4 times a year, you are expected to estimate what you owe in federal income tax and self-employment tax on your side earnings and send in a payment. And the deadlines don't even follow a logical calendar. They just land in April, June, September, and January. Not evenly spaced, not intuitive. They're just the dates the IRS picked, and that's when the money is due. If you miss a deadline, you don't simply owe the tax amount when you eventually file. You owe an underpayment penalty on top of it. The IRS charges you what amounts to interest for not paying them on their preferred schedule. This happens even if you pay every penny you owe on April 15th. Even if you file a perfect return. If the money didn't arrive in quarterly installments throughout the year, they penalize you for the delay. They want their cash flowing in throughout the year, not dumped on them in one pile at filing time. And this is the point where a lot of side hustlers hit a wall. Because estimating what you owe every quarter is not a simple calculation. It means projecting what you'll earn for the full year, which is hard to do when your income fluctuates month to month. It means figuring out which deductions you'll be able to claim, which you might not know yet. It means calculating self-employment tax on your projected net income, layering your federal income tax bracket on top of that, maybe factoring in state estimated payments too, and then cutting a check or making an electronic payment 4 separate times a year, while also doing the actual side hustle, while also working your full-time job, while also trying to have a life that isn't consumed by tax paperwork. It sounds overwhelming, and for the first year or two, it genuinely is for a lot of people. But there's a method that dramatically simplifies this, and most side hustlers have no idea it exists. If your side hustle income is on top of a regular W-2 job, you can increase the withholding at your day job to cover the extra tax. Here's how it works. You fill out a new W-4 form with your employer and specify an additional dollar amount to withhold from each paycheck. That extra withholding absorbs what you'd otherwise owe on the self-employment income. You're paying the exact same total amount of tax, but instead of managing a second payment system with 4 deadlines and quarterly calculations, you're piggybacking on the payroll infrastructure that already exists. One form, one adjustment, done. The IRS genuinely does not care whether the money arrives through quarterly estimated payments or through increased W-2 withholding. They just need to receive it throughout the year. And for most people who have a primary W-2 job and a side hustle on top, adjusting the W-4 once is enormously easier than building and maintaining a separate tax system. You make the change once, it takes effect the next pay period, and your withholding handles the rest automatically. Not everyone realizes this is an option, but now you do. So you know you owe self-employment tax, you know about quarterly payments, and you know the IRS expects its cut, whether you received a 1099 or not. But here's the part that most side hustlers completely miss. The tax code has a whole category of write-offs designed specifically for self-employed people. And every year, thousands of gig workers and freelancers miss out on thousands of dollars because they don't know what qualifies. That's coming up next. This is where you start taking money back. If you earn income as a self-employed person, you are entitled to deduct the ordinary and necessary expenses you incurred to generate that income. This means any money you spent to perform your side hustle is money you can get back, at least in part. Your self-employment earnings actually equals your total revenue minus your business expenses. So any money you spent can be subtracted from the money you made, and that is the amount that's actually taxed. Let's walk through real examples because I don't want to overcomplicate things with a bunch of numbers and definitions. Let's say you drive for a rideshare or delivery platform. Every mile you drive for that work is deductible. The IRS publishes a standard mileage rate each year, and for most gig drivers, this single deduction is the biggest tax saver they have. If you drove 10,000 miles for rideshare or delivery work over the course of a year, that deduction alone could save you thousands. But there's a catch. You need to log those miles, every trip, consistently. An app on your phone, a spreadsheet, even a notebook in your car. Dates, starting point, ending point, purpose of the drive. If you don't document it, you cannot claim it. And if you face an audit, saying, "I think I drove about this much," gets you nowhere. The IRS wants records, not vibes. Do you freelance from home? A portion of your rent or mortgage interest, your internet bill, your electric bill, all potentially deductible through the home office deduction. The requirement is that the space must be used regularly and exclusively for your business work. Your kitchen table where you also eat dinner, help your kid with homework, and scroll your phone doesn't qualify. But a dedicated desk setup in a bedroom corner that you use only for freelance projects, that counts. Beyond the home office, think about the tools of your trade: supplies, software, subscriptions, equipment. If you bought a camera, a microphone, or a ring light for your social media side hustle, those are legitimate business expenses. If you pay monthly for editing software, design tools, cloud storage, all deductible. If a platform takes a commission or transaction fee from your earnings, that comes off the top of your revenue. Your cell phone bill, at least the percentage you can reasonably attribute to business use, is deductible. If your phone is 40% business and 60% personal, 40% of that monthly bill is a write-off. Same logic applies to your internet if you work from home. Now here's the deduction that flies under almost everyone's radar. You can deduct 1/2 of your self-employment tax from your adjusted gross income. Remember that 15%? Half of it, the portion that represents the employer's share in a traditional employment arrangement, is an above-the-line deduction on your federal income tax return. The IRS gives you this break because you're shouldering both sides of a payroll tax that a traditional employer would split with you. This deduction doesn't reduce the self-employment tax itself. You still pay the full 15%, but it reduces the income on which you calculate your federal income tax. And that difference saves real, countable money every single year. The common thread across every single one of these deductions is documentation. Receipts, mileage logs, bank statements, records of what you purchased, when you purchased it, and why it was necessary for your business. The IRS does not accept estimates, doesn't take your word for it, and doesn't give credit for expenses you can't prove. If you want to use the deduction system, and you absolutely should, you need to treat your side hustle records like an accountant would. Not like someone who stuffs receipts in a shoebox and tries to reconstruct the year every April. Here's the single best organizational move you can make right now. Open a dedicated bank account or get a separate debit card exclusively for your side hustle. All business income goes into it. All business expenses come out of it. Nothing personal touches it. When tax time arrives, your bank statements are your documentation. Income in, expenses out, and the net difference is your taxable profit. Clean, organized, and ready for anything, including an audit. Drop a comment with your side hustle and the one expense you just realized you could be writing off. I bet there's at least one you've been missing. There's one more trap that the IRS sets, and it's subtle enough that most people don't even realize they've walked into it unless they're paying close attention. Your day job puts you in a specific federal tax bracket, which is a percent you owe based on how much you earned. However, when you stack side hustle income on top of your normal job salary, your total annual income goes up. And if it goes up enough, it goes into the next higher tax bracket. Before anyone panics, this is not as catastrophic as the internet often makes it sound. Tax brackets in the United States are marginal. That means only the income inside the higher bracket gets taxed at the higher rate. For a better explanation, watch my video on how your paycheck is lying to you. It explains everything you need to know to actually understand your paycheck, which is step 1 to financial freedom. Here's what should scare you though. That money you made from your side hustle that pushed you up a tax bracket, it's being taxed at 22%, plus 15% self-employment tax. That's over 37% of every dollar going to the federal government, and state taxes are waiting to jump on top of that too. If you're in a state that charges 5%, you're looking at 42% of your side hustle money going to taxes. In a higher tax state, maybe 45%. You earned $5,000 doing freelance work on the weekends, and the portion of that income sitting in the new bracket might net you closer to $2,900 after all taxes. Not $5,000, not even close. And this is the part people struggle to internalize, because it feels like punishment. You worked harder, earned more, and now you're keeping less money? But that's exactly how this tax system works. It's not necessarily designed to punish ambition, but it sure feels that way. Does that mean the side hustle isn't worth it? No, not at all. The money you make now can add up to big profits if handled properly. The knowledge you earn along the way means more than all the profits. A side hustle can help you work on your debt, savings, investments, anything that moves your financial life forward. But you have to plan around the real number, not the number that landed in your bank account, not the gross, the net. Because the gap between the two is what ends side hustles. I know this has all sounded pretty hard and discouraging, but it gets easier the more you do it. The difference between those who make it and those who don't is this moment, right now. Whether you stick through the hard to get to the good is up to you. This is where everything we've talked about comes together into one practical move. A lot of side hustlers accidentally create problems that didn't need to exist. They have a big quarter, maybe they landed a large freelance contract, had a surge of product orders, drove extra hours during a holiday rush, picked up a consulting gig that paid well. Several $1,000s flows in over a short period and it feels exhilarating. So they upgrade their gear. They take a trip, they pay off something large, they spend as if the gross amount is what they actually have. Then the quarterly payment comes due, and the money to cover it isn't there because it was already spent. So they skip the payment. Next quarter, they owe more, because the penalty from the missed payment stacks on top of the new amount due. Then they skip that one too, or they can only make a partial payment. It snowballs. And the side hustle that was supposed to give them extra breathing room, supposed to accelerate their financial goals, is now the exact thing causing financial stress. And this is a pattern that repeats with frightening consistency. It's the number one reason side hustlers say it wasn't worth it. A side hustle that earns you $5,000 and costs you a surprise $2,000 tax bill plus penalties doesn't feel like a win, even though the math technically works out in your favor. The emotional damage of that surprise bill is enough to make people quit. And that's a shame, because the problem was never the hustle. The problem was information. The fix isn't sexy, but it works every single time. The moment side hustle money hits your account, move 25 to 30% of it into a separate savings account, immediately. Before you spend $1, before you even think about it as income. That money in the savings account is not your money. Think of it as the government's money that happens to be parked in your account temporarily. When the quarterly payment arrives, or when you file in April, the cash is already there. No stress, no scrambling, no floating it on a credit card, no penalties. 25% if you're in a lower bracket and a lower tax state. 30% if you're near a bracket edge or in a state that takes a bigger cut. That's the rule. It's not glamorous, it's not complicated, but it works. Every single time. The side hustlers who do this sleep fine in April. The ones who don't are the ones writing panicked posts on Reddit about how they owe the IRS $2,000 they don't have. If you're running a side hustle right now, or you're seriously thinking about starting one, take 30 minutes this week and look at your actual tax picture. Pull up a self-employment tax calculator online, plug in what you've earned so far this year, and see what you actually owe. Then look at what you've set aside. If those two numbers don't match up, you've got some catching up to do, and it's better to know now than in April. Then set yourself up so you never get surprised again. Open a separate savings account for taxes if you don't have one already. Set up an automatic transfer of 25 to 30% every time side hustle money comes in. Stop treating the gross number as your actual income. And look at your W-4 at your day job to see if bumping up the withholding is easier for you than managing quarterly payments. You earned that money. Keep more of it by knowing the rules before the rules come for you. The side hustle is the easy part. The tax side is where most people lose the game, and you don't have to be one of them. That first side hustle payment still felt like a win, and it was one. You went out, found a way to earn money outside the system that pays your salary, and you proved to yourself that you could do it, that you could build something on your own time that actually puts cash in your account. That part is real, and nothing in this video changes it. What changes is how you handle the money after it lands. Because the difference between a side hustle that builds your wealth and a side hustle that creates a tax bill you never saw coming is about 30 minutes of setup and a savings account you don't touch until the bill arrives. The money is real. The tax bill is just as real. Know both numbers and the hustle actually pays off. Stack smart.